Hi, Mark Wilkinson here again. I just wanted to thank everybody who's logged in and watched the previous video that we've actually put up, and for all those that have downloaded the paper dealing with the way in which you can actually receive your transition to retirement pensions tax-free as a result of a private binding ruling that's been released by the tax office. So if we just can take a minute to just recap that strategy. In the past, what's occurred is that if a member between the ages of say 55 and 59, which so in other words that satisfied the preservation age, looked to commence a transition to retirement pension, they were able to structure that pension in such a way by making an election under Regulation 995-103 that their pension payment should be taxed as a lump sum. They were able to structure their pensions in a manner that pension would be received tax-free if their benefits were unrestricted, non-preserved. What's occurred in the last 2 months or so is that a private binding ruling has been released by the tax office, and in it they've substantially changed their position, such that now, in order to elect to have a payment that's made to you treated as a lump sum, it no longer has to be coming from an unrestricted, non-preserved source. That means that the strategy that has been limited to a relatively few people in the past is now available to all of your clients. So you need to talk to your clients about that. So it's a very, very exciting process. I acknowledge that there are issues about, in some cases, you having those discussions with clients about commencing pensions and other issues associated with them, but you need to be aware of exactly what the factual situation is. So, my background, 30 years involved in superannuation, advising advisors on a whole range of different things. I speak at SPA, I speak at the Institute's presentations, all of the major professional bodies. So hopefully you'll find some of that expertise coming through in this video, and I'll be able to help you in a whole range of ways. What I wanted to do in this video is actually just touch on a couple of the other issues that you need to be aware of when you're starting a pension, because at the end of the day what we're doing here, where the benefit lies, is for a member that is in transition to retirement pension, and there are specific restrictions that apply around that. So I've said previously, Tax Office changed its view. It now accepts that you can make an election with regard to a payment that you receive as part of a transition to retirement pension arrangement to have that taxed as a lump sum. As it's taxed as a lump sum, you apply the payment against your lump sum tax-free threshold for the current year, $195,000. So what are the issues that you need to be aware of? First up, while the payment is taxed as a lump sum, you're elected to have it taxed as a lump sum, it is not a lump sum. That means that it cannot be paid as an in-specie distribution of assets. It's still a pension, your benefits are still preserved, therefore being a pension, that pension must be paid in cash. So don't distribute assets under this particular strategy unless you've got an unrestricted non-preserved component. Second thing is that where you have unrestricted non-preserved elements and you're making the election, it's once again treated as a lump sum. If it's a lump sum, it does not count towards the 10% maximum pension payment that you're receiving. In this particular instance, all we're doing is reclassifying a pension payment as a lump sum for tax purposes. That means that if you are going to make a pension payment, you need to make sure that you've included it in your 10% calculation. That is the maximum that can be drawn down. If you pull out more than that, you'll find yourself having breached the pension rules. If your benefits are unrestricted, non-preserved, you'll be taken to a pulled out and illegal lump sum, and that will result in dire tax consequences. So you need to make sure you've actually got that right. The other thing is that you can't wind up a pension completely by paying out this lump sum benefit if they are all preserved. If you do that, once again you will bring the pension to an end, and the benefits that you've withdrawn will be taken to be illegal lump sum withdrawals, and as a result you'll find that there's a major problem there. Now, I wanted to raise two other issues with you as well. First up, we've mentioned a couple of times the minimum and maximum. You need to make sure that your benefits fall within that, otherwise in addition to having the excessive tax liability for having made an illegal withdrawal, you will also lose your income tax concessions with regard to the having derived exempt current pension income in the fund. And the final thing I wanted to mention is that this is a prospective strategy. The election to receive your pension payment and have it taxed as a lump sum needs to be made before the payment is made. So if we're going back to looking at 2014, you cannot go back and make that election with regard to that year at this particular point in time. What we're looking for is for payments that are made in the 15-16 year. The other thing that I would say is that you do need to be aware of exactly which way you go forward. The announcement's been made by way of private binding ruling. Obviously the professional bodies will push to get something more public released by the tax office. The fact at the moment though is that it's actually only binding for the particular taxpayer that's actually applied for it. So the question is, do you need a private binding ruling of your own? My view is that if you are in transition to retirement pension and you are not intending to pull it out any more than you otherwise would have, and you've got a reasonably arguable position with regard to the private binding ruling in your analysis of the legislation, you may not need it, but if the clients that you are giving that advice to certainly need to have it disclosed to them exactly what the risk is if they don't obtain a private binding ruling of their own. Needless to say, 30th of June 2016 is coming up fairly rapidly. Private binding rulings can be slow to obtain. If you are looking to utilise this, you need to move on it reasonably quickly. So hopefully that's actually given you a little bit of information around how the way pensions could work and how you could utilise these for your clients. I think it's an extremely valuable, transformative strategy actually for many clients. So make sure that you're up to date with it. Hopefully I've given you the information that you need to. In the next video, what we're going to deal with is we're going to see how you might be able to use Division 13.3A companies and trusts in conjunction with a tax-free pension or tax-free transition to retirement pension, and the advantages of using companies versus trusts and the derivation of income by the fund to actually improve the client's overall position. So don't forget, if you've got any comments with regard to this video and the paper, downloadable paper that you've got, please leave your comments on the blog. I look forward to reading them. And you should receive the next video in the next couple of days. Thanks for watching.